Hello everyone, this is Ken Martinez from Market Investments introducing the next video in our series of the cash flow calculator, personal finance. Let's get right down to the four pillars. On this tab, what I'm attempting to do is do a calculation of all the benefits of having rental property by highlighting what I'm calling the four pillars of rental property, which is principal paydown, appreciation, positive cash flow, and the tax benefits of having interest that is deductible and depreciation on a property. So like all the other tabs, the blue cells or input cells, you can mix and match anything that you want. Let me just go through a few things on this tab. So we have appreciation right now. I'm just modeling 1%. Probably don't want to go too much more. Certainly not guaranteed, but over time. And what am I looking at? I'm looking at a 30-year time period. Properties should appreciate over 30 years, so you do want to factor something in there. $100,000 property, put 20% down. And I'm just modeling for right now, this example, $100 a month cash flow, which is conservative, I think, for this example. 30 years, 5% interest rate, and we do have an inflation factor here, similar to another earlier video, 3%, and change it to whatever you feel is the inflation rate. Tax rate, put your personal tax rate. I just have 35%. And then cash flow, how much do you want your cash flow to appreciate over time? So that's what all of these input cells mean. And so over here, we're going to have a return on our investment. Our investment is based on a 5% closing cost in addition to the 20% down. So in this example, we have 20% down, which is 20,000, and another 5% closing. So I just have 25,000 is our initial investment. And then for depreciation purposes, since the land doesn't depreciate, does not depreciate, only the improvement on the land, which is your house, we do need to account for what percent of the total property is the land. I've just put 20%. You'd have to input whatever is appropriate for your particular rental property. Anyhow, so we do have principal. So let me just go through some of the numbers here. As you can see, the principal is going to increase every month as your tenant ends up paying your mortgage, and each month as you pay more and more, you pay more principal and less interest, and thus you have less interest to deduct. So these two columns are really going to go inverse. As you see, this column is going to decrease every month, or every year in this case, or I should really say, because you're paying less and less interest and then more and more principal. So these will work in opposite. Appreciation right now just going 1%, very conservative, but appreciation does compound. So that is the benefit of appreciation. Positive cash flow, again, we only have a 1% improvement, so very conservative. And it goes, it's worth saying that this is really what you want to buy. This is what you're buying on. You sort of don't want to buy for appreciation or tax benefits. This is what you want to buy. You want to make sure you're cash flowing day one. After that, you do want to recognize the other, or all four pillars, but really you should be just buying based on pillar number 3. And then you have your totals with and without inflation. So without is just the total of these, and with is using your inflation rate as a discount factor over time. So notice as these go up, you're being heavily impacted by inflation. Anyhow, so if you take all of these numbers and you divide them by what you invested, that's your rate of return. And then the totals here, as you can really see now, these huge returns really highlighting the benefits of owning rental property. Everything is over 30% over time, and then I have a graph here highlighting that, so you can see the total over time is really increasing up until you get to the very end, because we lose the depreciation here at the bottom, and then of course our interest rate deduction is decreasing at the end too. So you can see the effects also of inflation. This dotted line is it's really going down over time as inflation is compounding, and then other things are exactly like I said, the principal is going to go up and so on. So a couple of things I just want to mention here. If you just you want to take out one of them, like if you want to ignore depreciation for this example, just put 100% here. and then it doesn't get factored in. It's saying all of the properties in the land, so these will disappear. If you just want to ignore appreciation and then just put a 0% appreciation, this will go away. So you can separate some of this. If you want to ignore taxes, then just put a 0 on here, and then your taxes benefit is going to go away, and then everything else will update accordingly. So that's it for this tab. That is the 4 pillars. And if you go back to our table of contents and hit the races, I'll explain what these are. These are some fun, 3 fun scenarios I decided to put in. What I'm calling races, because it's really comparing 2 different races here. In this first example, conservative versus aggressive investment, what we're saying is what's going to end up as a better deal if you invest conservatively and don't lose money versus if you invest aggressively and possibly lose money. And that's what these inputs are. I have 7 for conservative percent return, 12 for aggressive. But for the aggressive, we lose money in year 5, and we're losing this amount, 75%. So as you look at the numbers down here, yeah, you can see if you lose that much money, how long it takes to recover. It takes a long time to recover if you lose this amount. So maybe we don't want to put that scenario. Maybe we just want to show 50%. But even at 50%, there's a total of 13 years it's going to take for you to recover on that. In order to compensate for that, you may want to, you can do different scenarios. Change it to 20%. And now because you're earning so much more, it's going to only take you 3 years. Or the other way to counteract the loss is maybe give yourself a few more years before you experience a loss, and then it'll take you a shorter time to recover. So that's what this scenario is. You can mix and match your scenarios of if you take a loss, when does your aggressive overcome your conservative? Over here on this part, so this is the benefit of starting early in your savings. So compound interest is starting early and then stopping versus beginning after, in this scenario, has stopped. And then which one is going to win out in the end on this race number 2 here. So I have the scenario of earning 10% and then stopping at year 3 and making depositing $2,000 a year. And you can see if you, in this scenario, as it compounds, it's going to take the starting late on up until year 8 for it to overtake the early one. And then you can start to mix and match with the different races here. Maybe it's gonna the early plan is going to invest for 2 more years, and you can see the effect of that just by investing 2 more years and 2 more years of compounding. It's going to push all the way down to year 15 before the late plan is going to overtake it. How about waiting till year 7? So waiting till year 7, in fact, the late plan never recovers, which is pretty interesting. So that's the whole power of starting early. If you wanted to sort of counteract that part, maybe you'd have to reduce the interest rate. Instead of earning 10%, how about just 5%? And then you can see now from never recovering to year 18 on that scenario, does the late plan overtake the early plan? Over here on our last scenario on the value of appreciation of your of a single-family residence. And so hopefully you have a nice property, or maybe your own property. It's in a nice area in a nice neighborhood, and so you're going to factor in appreciation of 3%. And just for this example, I'm just saying the house is worth $100,000, and here's your loan parameters. So you can see how much interest you're paying every year, and then the value of your property appreciation, how much is the appreciation. And so in year 13, what's interesting is that you've actually have more in appreciation that you've paid in interest. In many ways, you can argue you've had an interest-free loan. You've earned more from your property because you have a nice property, a nice area. You've earned more than you paid out in interest, and that's a good thing. So if you can get more appreciation than interest paid, you almost can say you've had an expense-free loan there. And just like the other scenarios, you can maybe change the appreciation to 2%. Notice what it does if you don't have as much. It's going to take you all the way to the end let's say year 28 before you overtake it. And you can mix and match. Maybe you're paying less interest, and if that's the case, then you're going to overtake, since you have less interest paid much earlier, say year 16. So different scenarios of when your appreciation will overtake your interest paid on your loan. And that's it for that. So again, this is Ken Martinez with Mark Investments. If you want to know how you can invest in your own copy of the cash flow calculator, please email me at mark55llc@gmail.com. Thank you.